I'm sure you have plenty of guests who will argue why it has to go to 6,000 or 10,000 or whatever, and I'm not saying they're wrong. So the fact that it doesn't seem to be going there, that it's catching a bit, that's really telling to me. If this continues, the longer this 4,000 consolidation goes, like if it did the same thing at 3,000, did the same thing at 2,000, and then what happened? It went up to the next big leg up. The longer this consolidation goes, the more confidence I will have that the next big move will be up, not down. Silver lags at first, but it's okay, don't worry, because silver always catches up at the end, more than catches up at the end.
China's central bank and related entities appear to be buying far more gold than they officially report, creating a large and opaque source of demand that is closely tied to a broader effort to reduce exposure to the US dollar, and that helps explain the current record bullion prices. Now, it's not news to you.
Analysts Lobo Tiggre and Lanci explain why gold's current consolidation around $4,000 carries far more strength than the headline volatility suggests. Similar multi-month pauses at $2,000 and $3,000 were the launchpads for the next explosive legs higher. The longer gold stabilizes at this elevated range, the more likely it becomes that the next significant move will break decisively to the upside. Silver's lagging behavior is typical. It waits, then surges violently once gold confirms direction. Beneath this price action sits a more structural driver. China's central bank and its extended financial system are absorbing far more bullion than officially reported, part of a long-term pivot away from the US dollar. That steady opaque bid underpins record pricing today and strengthens the case made by many analysts that gold ultimately has a clear path toward $10,000 in the coming cycle. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Gold is a global market, but we tend to quote the price of it, or in dollar, the gold-dollar exchange rate, I like to call it. So what happens with U.S. policy to the U.S. economy, the U.S. dollar, is relevant not just to gold, but to all commodities. And it's also the world's largest economy. So it's not irrelevant, even if you live in Switzerland or Shanghai, to pay attention to what's going on in the U.S. So anyway, my key takeaway is what the Fed is saying without saying is that we're in for stagflation, and makes me nervous, because to say we're in for stagflation, the obvious corollary is so that's good for gold and silver. But with gold over $4,000 and silver close to 50,
how much better can it get?
Right. And I'm sure you have plenty of guests who will argue why it has to go to 6,000 or 10,000 or whatever. And I'm not saying they're wrong. It just makes me a little nervous, because we had a hockey stick from 2,500 up to 3,000. We waffled a bit, and then we got another hockey stick. So if it hockey sticks again, that's 3 in a row. That's a pretty tall ask. I'm not saying it can't happen. Could be the stagflation story kicks in, and we end up with, Goldbug's dream come true, right? The next blow off top. Though, honestly, and I'll let you go with the next question here, I would much rather see actually a period of consolidation. I think that would be healthy, and it would give me greater confidence in the longevity of this gold bull. Whereas if we go right away into that blow off top, we all know what happens after the blow off top. And you're asking, so I'm answering the questions with what I think. I just want to make clear that I'm not predicting like gold's going to the moon. But it's striking to me that we're heading into an environment that should be bullish from gold, and we're heading into it from a level from 4,000. That's kind of exciting. This is the equivalent of me pounding the table, I guess. I try not to do that, right? But one more thing on this.
Yeah.
It's really interesting to me that gold is doing that beach ball thing. Like, it's gone under 4,000 and it just keeps coming back up again. And when gold hit almost 4,400, right, and then rolled over and it started going down, it was reasonable to say, where's the floor, right? And a reasonable, at least psychological, if not technical level, would have been 4,000. Does it hold 4,000? Because if it kept going down through that, the technical guys would say your next Fibonacci is like 37 and change or something. That would be a significant pullback, or a much bigger one than we've got now. Almost officially a bear market, right? So the fact that it doesn't seem to be going there, that it's catching a bit, that's really telling to me. If this continues, the longer this 4,000 consolidation goes, like if it did the same thing at 3,000, did the same thing at 2,000, and then what happened? It went up to the next big leg up. So the longer this consolidation goes, the more confidence I will have that the next big move will be up, not down. Right now, honestly, the next big move could still be down.
Yeah, right.
Well, that's always been the case. Silver's always been more volatile than gold. It also, though, has, I think, undeniably, people call me Darth because of my saying, though, but I think it undeniably has a much stronger response in price to its industrial side. It's always had an industrial side, like it was photography before. Now it's electronics and solar panels, but it's always had an industrial side. But that is clearly a stronger variable now. Like it really affects the above ground available stock in a way that doesn't matter for gold. So that's interesting to me. But I'm actually not even, that's not even where my head is on that. I do think that the thing I'm watching is that even your most diehard silver uber bulls will tell you that silver lags at first, but it's okay, don't worry. Because silver always catches up at the end, more than catches up at the end. Fine, I agree. Historically, this happened 9 out of 10 times. But if we're in the catching up at the end phase, that implies that we're in the end phase, right? And I don't think that's true. So it was concerning me that silver recently was screaming north faster than gold was. But we have a proximal cause for this: the physical squeeze in London. The price to borrow silver in London to meet physical demand, skyrocketed enough to fly some silver from New York back to London, and apparently more of it came from China to help resolve it. But I like this because silver's kind of reverted to trend. Like it started more than catching up with gold, and now it's reverted to trend, and that's good for the longevity of this market. You have more time for all of us to make money here. And this is an important point. My job, what my clients pay me for, is to help them make money, not to be ideological or religious about defending silver or gold or uranium or whatever it is. So don't get mad at me if I talk about taking profits or markets going up and down. The purpose is not to be a cheerleader for your favorite commodity. The purpose is to make money. And we make more money, I think, if we have years to go in this bull market, which ultimately takes us higher than if we get a blow off top now and then we have a bear market for years, right? So silver accelerating was worrisome because it might have signaled the end of the market. And silver correcting more right now brings it back to trend, and for me, that's a sigh of relief. The bull in monetary metals is stronger this way.
Lobo Tiggre explains why the current structure of the gold market supports the possibility of far higher levels ahead, including the $6,000 to $10,000 projections many analysts are now discussing. He emphasizes that the Federal Reserve's stance points toward a stagflationary environment, historically one of the most potent catalysts for monetary metals. Gold repeatedly defending the $4,000 level is behaving like a beach ball underwater, mirroring the same consolidation patterns seen at $2,000 and $3,000 before major breakouts. Silver's recent surge and correction have also normalized back into trend after a physical squeeze, extending the life of the bull market rather than signaling its end. This slower, healthier progression increases the probability of gold advancing into the next major leg, and silver eventually following with even greater strength. Let's get into the interview.
All right, so that's it. That's what's going on right now. If you want to read more about that, Zero Hedge has let me see if that's premium. Zero Hedge has a story out called Futures Tumble as AI Euphoria Goes into Reverse. Perfect headline. It's not locked. I would suggest you read that if you want some insight into the stock side of it. All right, so breaking. The FT put out a story yesterday. The FT asserts China's hidden gold buying drove the record rally. As noted in this space and detailed using proprietary methods, breaking down reports from Goldman Sachs, SocGen, Jefferies, and our own observations, paraphrasing James Rickards several times in this space, over the last 3 years, China's central bank and related entities appear to be buying far more gold than they officially report, creating a large and opaque source of demand that is closely tied to a broader effort to reduce exposure to the US dollar, and that helps explain the current record bullion prices. Now, it's not news to you. Oh, let me shrink this a little bit. That's my notes on the side there. That's not news to you, but it is news to most of the world that we live in. So that's going to raise awareness. It doesn't matter. Does what's happening today matter? No. Is China not buying today? Of course they're buying. But here we go. China's real gold buying is far larger than the official numbers, according to that new work highlighted by the Financial Times and reinforced by our own multi-year analysis. The PBOC reports small monthly addition, yet evidence from SocGen, Goldman, and London bar flows suggests China may be acquiring hundreds of tons through hidden channels tied to its de-dollarizing strategy. Analysts quoted by the FT, SocGen mostly, say China's true holdings could already be near 5,000 tons. It's more than that. Only 1/3 of global central bank buying is now reported, creating a powerful, opaque source of demand that helps explain gold's record highs. We also noted that only 1/3 of gold central bank buying is being reported now. So 2/3 is not. And it probably has been that way for years. We would remind people that China's army wealth is not on their balance sheet. It's separate from the government. The army and the government are separate. That happens in a lot of countries that aren't liberal democracies. The army is separate from the government. And so when, as James Rickards used to say, when the army wants to buy gold that doesn't get reported. They need to make sure they're self-sufficient. In the case of Revolution, and that happened. I don't want to get it destroyed today. All right, so the good news is there is no good news. No, the good news is the bad news is we went back below that area. Shit. Look at that ledge, like an evening star type of thing down. So now we're looking at this here. Now, I don't expect this to hold, okay? I've already come to terms with the death of that line. I want this to hold, which is 3,900. If we stop here and go back up, that's great. In fact, we're probably being bought right now by sovereign wealth funds, by central banks. That's what it was. The FT said they and SocGen are talking more about the who else is buying. It's not just central banks, which we know. It's sovereign wealth fund. It's entities that are off balance sheet, like the military. That's what they were saying. Anyway, I'm Vince. It's Friday. On the week, we're doing much better. Here's the zoom out thing. On the week, there's the S&P chart for the week, right? What is that on the week? I don't have the percentages up there. So that's 67.40, 66.70. So it's down 10% on the week. Is that 10% or 1%? 1%. And gold is still fucking green, okay? Shitty green, but green. Silver may still be green as well. It has to be, right? Yeah, still green. So the trade is, as I didn't do, but I said I was going to do, is short tech and buy miners. That's the trade.
What becomes clear from Vince Lanci's breakdown is that the actual engine behind gold's strength isn't speculation. It's sustained opaque accumulation by China's central bank, sovereign wealth entities, and off-balance sheet institutions that don't publicly report their buying. As global awareness begins to catch up, even mainstream outlets now acknowledge the scale of hidden demand driving bullion to record levels. Lanci emphasizes that much of this activity is deliberate de-dollarization, with potentially thousands of tons acquired through channels far beyond official PBOC disclosures. This deep bid absorbs every dip, even as Western markets focus on volatility. Meanwhile, risk assets unwind, tech weakens, and mining equities continue outperforming. The broader rotation is unmistakable. Capital is leaving overvalued sectors and flowing into tangible monetary assets backed by real purchasing power. In this environment, the long-term trade remains clear. Own the metals, own the miners. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.